Shares of Chinese EV maker NIO have soared by almost 40% since the first week of April, with one Wall Street analyst convinced NIO will double to $8 by the end of 2025. However, right now NIO is trading at $4 and is still in a long-term downtrend. So, how will NIO turn things around in 2025? And why is one analyst so confident the stock price will double? In this video, I'll look at the recent news around NIO and map out the possible steps that need to occur if price is to reach $8 by the end of 2025. China is the world's largest EV market, with electric and hybrid options representing more than half of all new car sales in the entire country. But this potential opportunity has slowed down by excess competition. According to CNN, the country boasts more than 200 EV makers, leading to a massive oversupply of cars and a race to the bottom in pricing as different companies struggle for market share. Even industry leaders like Tesla are struggling, with March sales in China down 11.5% year over year. A highly competitive environment will likely be even more challenging for smaller companies like NIO because they have lower economies of scale advantages and are less able to absorb losses during a price war. NIO's earnings highlighted the complexities of the EV industry in China. Fourth quarter revenue jumped over 15% year over year to 2.7 billion, but profitability remains out of reach with an operating loss of 826 million. While this operating loss is down 8.9% from the prior year period, it still looks like an unsustainable rate of quarterly cash burn, especially for a company with a market cap of just 9.1 billion. So the only way out of this situation is to scale. NIO will have to sell more cars to take advantage of economies of scale and reduce its fixed costs per unit. And management could achieve this by trying to expand outside of China through new brands and aggressive export strategy. In late 2024, NIO launched its Firefly brand, designed to offer small, higher-end cars and gain a foothold in the European market. It'll compete with rivals like BMW Group's Mini when it becomes available on the continent in the third quarter of this year. Firefly's sole model starts at just under 17,000 in China. However, continued trade uncertainty makes it unclear what pricing will look like in the European Union. But Firefly isn't NIO's only growth engine. According to CEO William Li, the company plans to launch 9 new and refreshed models across 3 brands this year, which will enjoy higher gross margins and potentially help it financially break even by the end of 2025. The new optimism comes after the company showcased its newest brands, Onvo and Firefly, at the 2025 Shanghai Auto Show last week. Its flagship Onvo L90 SUV also made its debut at the show. Both sub-brands are aimed at more of a mass-market EV buyer, offering lower prices without sacrificing many of NIO's leading EV technologies. And since the first week of April, shares in NIO have increased by almost 40%, with Citigroup analyst Jeff Chung believing there's more to come. In a report Chung released last week, the analyst placed NIO on a 30-day positive catalyst watch. Chung even thinks the stock is worth around $8.10 per share, which would represent a more than 100% gain from its current price of around $4. The Shanghai Auto Show impacted analyst Chung's opinion on the stock. He wrote, and I quote, "After the Shanghai Auto Show, we expect NIO to launch new models much earlier than consensus expected. That could mean 10 new models launching by the end of 2025. The analyst envisions that sales could increase by 50% sequentially into the second quarter. He believes deliveries could soar to at least 63,000 units, which would set a new sales record for NIO. And Chung thinks investors should buy NIO stock now, with the stock expected to trend towards its $8 price target as those models launch and upcoming delivery reports show improved data. While this narrative is certainly possible, there was no immediate reaction in the share price following this news. And NIO's growing sales numbers are looking positive. NIO's annual deliveries more than doubled in both 2020 and 2021. However, its deliveries only increased 34% in 2022 and 31% in 2023. And it attributed that slowdown to tougher competition, supply chain disruptions, adverse weather, and China's economic slowdown. Its vehicle margin also dropped from a peak of around 20% in 2021 down to 9.5% in 2023. However, in 2024, NIO's deliveries climbed 39% to just over 221,000 as its vehicle margin rose to 12.3%. And that acceleration was driven by stronger sales of its flagship ET series sedans and on-road SUVs in China, market share gains, and ongoing expansion into Europe. And NIO hasn't posted its full first quarter earnings report yet or provided any exact guidance for 2025. However, its deliveries grew 44.5% year over year to 65,994 vehicles through to the end of April. And that growth was driven by rapid sales of its core NIO vehicles. Its new on-road L60, which closely resembles Tesla's Model Y, and the initial deliveries of its new Firefly compact cars, which target interest in smaller vehicles like smart cars and BMW's Mini. Its margins are also improving as it sells more of its higher margin premium vehicles. So based on all this data, is NIO stock undervalued right now? For the full year, analysts expect NIO's revenue to rise 39% to 12.5 billion as it looks to narrow its overall net loss position. With an enterprise value of 10.6 billion, NIO trades at less than 1 times this year's sales. By comparison, Tesla still trades at nearly 9 times this year's sales. Therefore, any good news could force investors to revalue NIO and drive its stock price higher. NIO's potential near-term catalysts include a trade deal between the US and China, the EU replacing its tariffs against Chinese EVs with minimum price limits, and its rumoured plans to sell a controlling stake in NIO Power to the battery giant CATL. When it comes to EV stocks, Chinese players are cheap compared to their US counterparts. With the price-to-sales ratio of 0.9, NIO shares are dramatically more affordable than unprofitable American EV makers like Rivian Automotive and Lucid Group, which trade for 2.8 and 7.7 times their 12-month sales respectively. This dynamic makes NIO look like an excellent deal, especially if it manages to break even by the end of the year. That said, a company's stock is only worth what other people are willing to pay for it. And only time will tell if NIO management can boost sales and reduce costs. This would entice new investors back into the mix and will help the share price increase towards the prediction of $8. For more details on Citibank's $8 prediction, check out this video next. Thanks for watching.